Thursday, July 21st, 2022, Monaco 64, home of alternative economics and contrarian views. So as the old saying goes, all roads lead to Rome. And I think it's really appropriate, that saying now, because Italy's on the brink of another government collapse, which is not really surprising because Italy's had 69 governments since the end of the war, World War II. But I think the financial situation in Italy could trigger a major financial crisis for the whole world, and we're going to look at that today. Before I start, I like to say that I did a second video yesterday evening, and it's about the Bank of England, because in my usual morning video yesterday, I noticed something in the Bank of England inflation calculator that seemed wrong. It looked like they had tinkered with the numbers. So watch the video I did last night if you haven't watched it yet. I'm going to put it up in the cards and below in the description. It's entitled Bank of England Flagrantly Fudges Inflation Data. And before we go into what's happening in Italy, we're going to go through some stories, important stories that all kind of correspond or tells us that we are in a major debt bubble and that the central bankers are in trouble. They're telling us that they want to raise rates, they want to tighten policy, but the debt bubble could explode if they don't do something about it, i.e. if they don't pivot and keep inflating. It's the old saying of inflate and die or die. And of course, today the ECB has its meeting at 12:45 London time. They're expected to raise rates from minus 0.5% to minus 0.25%. Some people think they're going to raise it by half to take it to zero. But with the situation in Italy, which we're going to look at in a minute, I think that's going to be tough. So talking about the Bank of England and fudging the inflation data, there's a story out today, big headline in the FT. UK debt interest payments jump to all-time high. Figures suggest limited fiscal space for tax cuts as public sector borrowing also soars. So that's related to the Bank of England because they want to keep a perception that they're under control, inflation's under control, and that they're going to solve everything. And why is that? Well, because they want gilt yields to stay low, around 2% where they're now. They should be more like 10 or 12. And then the UK government would collapse. It would go bankrupt. And at 2%, we are already getting record interest payments. So you can see why they're in a bind. And that's another reason why, and I have to say, it is kind of discouraging to see what the fiat price of gold and silver are doing. But I've been through this for 20 years, and it's difficult, of course, because there's an old saying in the If poem by Kipling that, yes, you need to be sure of yourself, but sometimes you need to doubt yourself a little bit. You can't be too, how can I say, yeah, things are not certain in life, but it's still, for me, to think that I'd want to swap one of these, so a sovereign, about 0.2345 of an ounce, for this, and then put it in the bank, knowing what's going on. That's how I keep going, because the alternative is really not worth the effort, and we're going to come into that in a minute as it pertains to what's happening in China. But yeah, I thought this was interesting that already at where rates have risen to around 2%, we're getting this a problem with the UK finances. It says UK interest payments on government debt jumped to the highest level on record last month in a sign of the limited fiscal space available for tax cuts. I would say it also points to the limited space for monetary tightening, because it means interest rates will go higher and their debt servicing will go higher as well. So debt interest payments rose to almost 20 billion pounds last month from 10 billion more than in June. So there you go. That's what happens when government bond yields start rising. As for China and why, I think it's still good to hold these. We're hearing of bank runs in China now. Wall Street Silver tweeted out yesterday, tanks are being put on the streets in China to protect the banks. This is because the Henan branch of the Bank of China declaring that people's savings in their branch are now investment products and can't be withdrawn. So what does this mean? Well, this means that they've done a bail-in at the Bank of China at the Henan branch. And how do I know that they've done a bail-in? Well, because that's what they did in Cyprus in 2013. People with deposits more than 100,000 euros in Cyprus, they lost all their cash, but they were given shares in the banks that they had their deposits in, shares in those banks, that the banks that were almost bankrupt. So they've done the same thing in China. I've read that they've paid out the depositors up to like $7,000, but everyone with an amount above that, their funds have been frozen. And I can bet you they've given shares to them in the Bank of China. And that's a bail-in. And that's another reason why you want to have some of your savings you can keep. And I'm not trying to convince anyone to buy gold or silver, but yeah, you can keep these in the bank or the digital entries, or basically it's an unsecured loan that you give to the banks when you put your cash balances with them. You can keep them there, but just beware that if you have a lot. In the UK, it's over 85,000. You could be bailed in. You know, your account could be bailed in to save these banks. Yeah, they would give you shares in NatWest or whatever, or in whatever bank you have, but they would be pretty much worthless. They would be worth maybe a tenth of what you had before, above the limit. So that's why I try to keep this outside the bank as an insurance policy. And I think the fiat price of gold and silver, maybe it won't even matter if what's coming, if what I think is coming happens. And it's not just me saying that now. It's people like Bob Moriarty. He says, do you care what the price of gold is in Zimbabwe dollars? And I think he's right. So that's happening in China. We're also seeing Chinese city Zhengzhou sets up bailout fund as mortgage boycott spreads. So we've got the interest payments in the UK are going through the roof. We've got bail-ins in China. We've got mortgage boycotts. And what's all this got to do? It's all the debt. It's the debt. And unless the central banks pivot, the world is going to go into a tailspin. And Italy, what's the problem with Italy? Well, the problem with Italy, let's go into Italy now. And I've been covering this since the beginning of June. I made a video in the beginning of June, and I've been updating you. And at the beginning of June, the bond markets were in trouble in Italy. Yields were spiking. They calmed down a bit in the last 6 weeks, but now it's starting to kick off again. And the political situation is not a surprise in Italy. When I started out in the city of London, I did a lot of business with Italy, had a lot of clients there. I traded the Italian government bonds when you still had the lira. And political mayhem in Italy, or chaos, is par for the course. So that's not surprising. The surprise right now is that Italy is part of the eurozone. It has the euro. Its debt has ballooned. Its economy is in the dumps. And Mario Draghi, who's a caretaker prime minister, it looks like he will finally resign, and they're going to have to call general elections in Italy. The next general election was supposed to be early next year, or in the first half of 2023, but I think it could be very soon, and that will create a lot of uncertainty. Mario Draghi was like a steady hand. Not that I like the guy. He was a steady hand in terms of keeping the financial situation under control, because he's a former Goldman Sachs banker. He was a former Italian treasury official. He was the governor of the Bank of Italy. He was the ECB president. So the guy knew what was going on in terms of the markets. And now with him going, and the prospect of a lot of uncertainty, could be the spark that sets up a major, not just Italian financial crisis, but world financial crisis, which of course would start with the EU or the eurozone. And as you can see, the debt is always the problem. Italian public debt to GDP is 175%, and it's probably a lot higher. These numbers are always doctored. Japan as well. We've seen the yen collapse this year, and their debt to GDP is almost at 300%. The UK, I would say, is the same thing. It says here that it's 103, but I would say it's more like 150% of GDP. And the same goes for the US. They're telling us here that it's 100%, but it's more like 130. And if you look at GDP and look at the part where they add government spending, if you take that out of GDP, not just in the US, but everywhere, I would say the debt to GDP ratio in the US is more like 175. And why does it show 100 here? Well, because I think it takes out debt that's held by other government agencies, so they don't count it. But believe me, it's a problem. Yeah, it's a very interesting day, because we've got Draghi here expected to resign, as you can see by the headlines. We've got the ECB meeting. There's been speculation that the ECB will raise rates by 50 basis points from minus 0.5% to 0. With what's going on now in the bond market, I think it will be difficult for them to do that. So let's just have a look. Italian, the 10-year yield, that's gone from around 320 a few weeks ago, and today, or a few days ago, excuse me, and today it's reached as high as I think 362. So it's up 13 basis points. It was up significantly yesterday afternoon as well. And yeah, I think it's going to keep going higher. And back in the beginning of June, when I was looking at what's going on, end of May, beginning of June, the 10-year yield in Italy had gone up to around almost 4.5%. So there's still a lot of room on the upside. We need to keep an eye on what's going on in Italy, and it could set up a daisy chain reaction. And I've always thought that the crises that we've had in the last 25 years or 30 years or so are becoming worse and worse, and they're becoming different kind of crises. In 2000, 2001, we had the dot-com bubble burst. And then in 07, 08, it was a real estate and banking crisis. The banks almost collapsed. Wall Street, City of London. And yes, March 2020, I guess you could say, was a liquidity crisis, or yeah. And I think it showed us the first signs that the next crisis will be a currency crisis, a sovereign debt crisis. What's sovereign debt got to do with currency? Well, because the currency is backed by sovereign debt. So if government bonds from around the world collapse, the currencies will collapse. And the dollar is not any different. The only reason the dollar seems to be strong nowadays is because all the other fiat currencies are a derivative of the dollar. The dollar is the link that we still have with real money, with gold and silver, because up until 1971, the dollar was as good as gold. And the price of all the exchange rates against the dollar and all the prices that we see in the markets, in the economy, are derived from when the dollar was as good as gold. So gold is very important. Gold will be, and silver will be, the money that will be left standing when all this unravels. Time-wise, I don't know how long it's going to take. We could see the central banks panic and try to save everything again, but that will just mean more and more of a hyperinflation, more inflation. And if they don't save the system, if everything implodes, you want to have gold and silver outside the system as well, because there will be so many bank failures, corporate bankruptcies, governments will collapse, that you will, as a creditor in the fiat currency system, be left holding the bag. So that's where we are right now. I wish I had better news for you, but that's the way I see it. So let's quickly look at where the markets are this morning. It's 8:39 a.m. London time. Spot gold is at 1691, down 5. I don't think this price means anything, to be honest. I heard yesterday that Andy Schechtman from Miles Franklin sold $50 million worth of silver to a Texas billionaire, and that this lady plans to buy $1 billion worth of silver. The first 50 million, she will have to wait till August to get the delivery, and he had a tough time sourcing 50 million worth of silver. Can you imagine trying to source $1 billion? And I think this individual will do it in installments. They won't do it all at once, but it would definitely put the cats amongst the pigeons if she tried to buy $1 billion in one go. And she was buying Silver Eagles. She wasn't buying Crimex or Comex futures. So silver, yeah, we're down 15 cents at 18.50. High's been 75, low is 44. Gold, the gold high has been 16.98, and the low has been actually 85. So there you go. The Dow futures down 35. The NASDAQ futures down 31. S&P futures down 5 points. FTSE is down 20. Eurostoxx 50 is down 7 points. You might be wondering where Billy is. Well, he's right behind me on the wooden floor. It's much cooler today, but he's still a little bit uncomfortable with the heat. We have been out. He has had his breakfast, so he's fine. To the currencies, we got sterling down slightly at 119.63. The euro is up 1/3% at 102.13. The dollar is up 1/4 versus the yen at 138.56. Dollars up slightly versus the Swiss franc, 97.25. Dollars down, well, it's basically unchanged versus the yuan at 677. Now let's have a look at the Russian ruble, which to me now seems like almost like a safe haven currency, which we can't get a hold of. But I would say having gold is kind of like having the Russian ruble. While the dollar is up 3% versus the ruble at 55.50 this morning. To the general commodities, WTI crude is down 1.3% at 98.40. Brent is down just over 1% at 103.35. High-grade copper is down 1.2 at 328.60. U.S. nat gas is down 3.7% at 760. My view on hard assets commodities has not changed. I still believe we are in a secular bull market only because we are in a bear market. We are unwinding probably the biggest paper asset, financial asset bubble in the history of humanity. And a lot of capital will flow into real things, even if it's only 2 or 5% of the existing paper bubble. It will make a huge difference to commodity prices. And that's why I think the next few years are going to be painful for normal stock and bond market investors. And it will be painful for consumers as well, because all the basic necessities that we need to live on are going to stay very valuable in terms of the fiat currencies as the fiat currencies drop in value. So I still think it's good to have an exposure to hard assets and commodities. It will, I think, help you navigate, that's my opinion, the next few years in terms of preserving the value of your savings. So let's look at where the bond market is. The 10-year yield, the US 10-year yield is up 2 basis points, almost at 306. The 2 years at 325. So the curve is still inverted, no change there. And we're going to keep an eye on Italy and what goes on there today. I think he will resign. They're going to have to call a general election sometime in the next few weeks, I guess. And ECB as well, that's going to be key. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And with that, I wish you all a great day. Take care. Bye.